This is the exam review for exam 5. This exam will be taken on June 30th. You have from 12 a.m. to 11:59 p.m. And for this test, you will have 2 hours to take the test. There are several forms, again, that you're going to have to upload. And so I want you to have ample time to be able to do that. So you get 2 hours or 120 minutes to take the test. With this test, again, just like with the other 4, I'm asking that you use your academic integrity or honesty and not use any demos or homework papers or the internet. Make sure that you're not having somebody coach you or take the test for you. With this test, there is going to be the need for a calculator, so make sure you have a calculator available. And for the 2 ratios, you will be able to have those formulas written down to access those. Please do that. Please write them down so that you have them, because I have noticed that a few of you are skipping some steps. So make sure that you do have those there and show your work on those calculations. With this test, there's a lot to remember with our depreciation titles, our depletion, and our amortization titles, along with the payroll as well. So please make sure that you do study, use the examples that I'm going to give for studying, and make sure that when you are going through the test that you do show your work. All right, so with this test, I'll go through what we're going to be doing for this last test, and then we'll go by step. You're going to calculate straight line depreciation and units of production depreciation, and you're going to journalize both those entries. You're going to calculate the acquisition cost or the bundle purchase of some assets and journalize that. You're going to calculate out the depletion expense for an asset. You're going to journalize an entry to amortize a patent. You're going to journalize the payroll, so it'll be the employee's payroll and then the employer's part. And then you're also going to have one problem that's going to deal with warranty. And then you're also going to compute depreciation for a machine under the straight line and the units of production methods. And then your 2 ratios, your times interest earned ratio and your asset turnover. All right, so let's start with calculating the straight line depreciation. A very good example to follow for this is exercise 10.4 and 10.5. Now with this, you had purchased an item, piece of machinery, for $43,500, and then there was a $5,000 salvage value. Then there's also a 10-year useful life. So in the test, I will give you the cost, I'll give you the salvage value, and the useful life. So for straight line, remember it's the same every year. And so again, you take the cost minus the salvage value and divide it by its useful life. So for exercise 10.4, you're going to take the cost minus the salvage value, divide it by its useful life, and that will give you the amount of the depreciation. Then you'll journalize that, and you'll use your depreciation expense and your accumulated depreciation, and you'll record, in this case, $3,850. So again, you'll debit depreciation expense and credit the accumulated depreciation. Remember that your accumulated depreciation account is to keep track of all of your depreciation for the entire life of the asset. For units of production, you're going to start with the cost of the machinery minus the salvage value, and then instead of dividing by its useful life in years, you're going to divide by its useful life in units. And that's going to give you the depreciable rate per unit, and then you're going to multiply by how many units that item was able to produce during that year. So for exercise 10.5 with units of production, here you had the cost, which was $3,500 minus the salvage value of $5,000, and then you had the useful life, which in this case was 385,000 units. That gives you a depreciable rate of 10 cents per unit. This machine was able to produce in the second year 32,500 units, and so you multiply that, and then you get the depreciation rate or the depreciation of $3,250. So again, cost minus salvage value divided by its useful life in units. So this is how many units the machine was able to produce during its lifetime. And then you take that depreciable rate, in this case was 10 cents, and then you multiply it by the number of units, 32,500 that it was able to produce during its lifetime, and you come out with $3,250. To journalize that entry, it's depreciation expense and accumulated depreciation. So again, the titles will be the same as it is for the straight line entry, that'll be for the units of production. Now, for that problem, just like with this one, you're going to have the same cost, the same salvage value, and then you'll have your years for straight line, and then the number of units for the units of production. So that will be a combined problem. You'll see it on the review as two separate bullets, but it's a combined problem. Again, depreciation expense and accumulated depreciation for both of those journal entries. Okay, calculating out the acquisition cost of an asset. This was problem 10-1A that you did for a homework item that was submitted through Canvas. You purchase a building, land improvements, and vehicles for a total of $900,000. When the appraiser came through and appraised how much the value of each of those four assets were, the building was $5,088. The land was $297,600. The land improvements $28,800 and $124,800 for the vehicles. That all adds up to $960,000. Now, to get the percent in the middle here that you think or that we feel is going to be part of the bundle purchase of $900,000, you're going to take the building and divide it by the total of the appraisal of everything. So again, you take your 960 or your 508,800, the estimated market value. Make sure that this doesn't have like a lot of decimals here. And then you're going to divide by the total market value or what the appraiser said, and that came out to be exactly 53%. So again, the estimated market value in this case of the building divided by the total market value of all four assets gives you 53%. Again, the land divided by the total gives you the percent. The land improvements divided by the total gives you the percent. And then your vehicle divided by the total gives you the percent. This all has to add up to 100%, and make sure that you do that on the test. I will give you the estimated market value and the total that you purchased the bundle or the asset purchase. I'll give you that as well. Now, when you go to multiply, you have to take your 900,000 and multiply that by 0.53 so that you can get your 477,000. And then again, you take your 31 times 960,000, 0.31 I should say, 0.03 in this case for the land improvements times 900,000, and then your vehicles were 13% times 900,000, and that again will give you the acquisition cost. So again, what out of that 900,000 each one of those assets cost. That has to add up to 900,000 what you paid for. Okay, so if you didn't do everything correct on problem 10-1A, make sure you go back and check that. Now for the journal entry, you just list the four assets in this case. Those are your debits because we're opening up ledgers. We purchased those, they're debits. And then the cash is going to be your credit, and that's going to be the total 900,000. So again, you have your four items that you purchased. Those are the debits, and then your cash is a credit. You can practice again or look at the straight line depreciation for part 2. You did not have to do part 3. A lot of you did that, and we did not learn double declining balance in the demo. And I explained that, and you did not have to do that for part 3. That was not part of your responsibility to do that. So you only had to really do just part 1 and part 2 for problem 10-1A. So you probably pulled your hair out doing part 3 because we didn't learn that. But again, you can practice part 2 for the straight line, which is the cost of the building. You use the acquisition cost minus the salvage value divided by its useful life, and that was 30,000. Okay, then for depletion expense. Now remember, depletion means that we can't go back and replenish it. So it's going to be like coal or oil, or things like that. Timber is one of those as well because it takes a long time to grow a tree. So any of our natural resources are usually depletion for the for this part of it when you record the depletion expense for an asset. Now I'm going to show you quick study 1013 for this. You're not going to have to journalize the purchase of it, just the depletion part. So in this case, the ore mine was purchased for $1,800,000 with a useful life of $200,000, and during the lifetime, 1 million tons are able to be produced. That gives you a depletion rate of $1.60 per ton. Then there was 180,000 tons that were mined and sold during that time. So that gives you 288,000. So again, you take the cost minus the salvage value divided by how many tons or whatever they give you for was able to be gotten out of the natural resource, and that gives you the depletion rate. And then in this case, 180,000 tons were mined, and so you multiply that by your $1.60, and you get your answer of 288,000. Now your titles are depletion expense and accumulated depletion. So natural resources are depletion expense and accumulated depletion for those, for all natural resources. All right, amortizing, entry to amortize a patent. Now I'm going to show you, you're going to do a patent on the test, but I'm going to show you a copyright because we did a problem with a copyright for the test or for your homework problem. Okay, so with that one, this is exercise 10-21. And with this one, again, you're not going to have to journalize the purchase of it, just the amortization. So this is a copyright, in this case for exercise 10-21, that was purchased for $418,000 and its useful life is 10 years. So you're going to take the $418,000 divided by its 10 years, and its amortization for each year is $41,800. Again, that's amortization expense and accumulated amortization. Amortization expense and accumulated amortization. Debit the expense and credit the accumulated amortization. Cost divided by its useful life. Okay, so that is those parts. I want to skip down. I'm going to skip down in your review to compute depreciation for a machine under the straight line and units of production depreciation methods. This is going to look exactly like problem 10-2A. Now, if you did not do problem 10-2A, you need to go back and practice that or do the B problem. You can always do the B problem. You can do that for 10-1B. Do the B problem to practice your acquisition of your assets. What I'm going to do is I'm going to give you a table, and you will, in the form that you're going to be given, I'm going to double check that, make sure I'm right. Let me go back here a second. Okay, so this is, okay, so what I'm going to do is I'm going to give you a table for your answers for your straight line and units of production, and then I'm also going to give you an area for work. So I will show you what I mean by that here. All right, so I'm going to give you a column for this part and a column for this part. We're not doing double declining balance, so you'll not have anything for this. Then I'm going to give you this work area. If you use the work area, great. If you don't, that's fine too. But if you use this work area, make sure your final answers get up into the table at the top, because this is what I'm going to grade up here. With that, again, use this example to study from or do the B problem for extra practice. All right, so this was a machine that cost $257,500 with an estimated salvage value of $20,000. That gives you the depreciable cost of $237,500. So cost minus the salvage value gives you the depreciable cost, and again, that's $237,500. For the straight line, it's 4 years in this problem. So you divide the $237,500 by 4. Each year is going to be the same, $59,375. So you're going to, once you calculate it out, you'll put your answers in your straight line, total that up. It needs to equal what you have for your depreciable cost, $237,500. Now, for the units of production, I will give you the number of units that are going to be produced from the machine each year, and then you're going to calculate out the unit cost and then the depreciation. Now, with that, you're going to take the depreciable cost of $237,500 cost minus salvage value and divide it by the number of units that this machine is supposed to be able to produce during its lifetime, which is 475,000 units. So the depreciable rate is 50 cents per unit. In this case, 50 cents per unit. Then you'll take the number of units and multiply that by your depreciable rate, and that will give you the amount of the depreciation for the year. So for year 1, it was 220,000 units. Year 2 was 124,600 units, 121,800 for year 3, and then 15,200 for year 4. Multiply by 50 cents, and that's going to give you the depreciation for each year. Now, if you remember, back when we did the this problem here, and if you checked it, you will notice that for year 4, that the depreciation is only $43,000 or $4,300. When you calculate out 15,200 times 50 cents, it comes up to be 7,600. If you put 7,600 with the other 3 depreciation years, that's going to take you over your depreciable rate. And you cannot be over your depreciable cost or rate. The IRS does not let us do that. So you can only take enough depreciation that last year to get you to the depreciable cost of $237,500. So if you went to check your homework and you got the wrong answer, this is why. So this last year, again, we can't put the 7,600. We can only put the difference. So if you add up the 3 and subtract it from the depreciable cost, $237,500, that's $4,300. And then when you add these all up, it has to equal what your depreciable cost is. So when we add these all up, it can only add what your depreciable cost is, $237,500. So please make sure you practice that. If you did not do problem 10-2A, practice it and then practice the B problem, but make sure you know how to do that. Straight line's the same every year, but units of production is going to be different because it depends on how many units it's able to produce. So again, the last year, 7,600 is the answer. However, because of the fact that that would take us over our depreciable cost, we can only recognize 4,300 in depreciation for year 4. So that if you got that one wrong, that is your explanation for that. Okay, payroll. For the payroll, this is a big part of the test. This is a very big part of the test, and I hope all of you enjoyed payroll. I love payroll. I think it's very fun. Now, with this part of the test, it's 22 points. 22 points for this part of the test. So, with that being said, you're going to be given, for this part of the test, you're going to be given the total salaries for the month. You're going to be given the rates for Social Security and Medicare, and then the federal tax as well. So you'll be given those percentages. Remember, the 6.2% and the 1.45 is real world. Those are real world numbers that come out of your check when you get paid every week or every other week. Or if you get paid every month like I do, being a retired pension person, that's what I get. Now, with that being said, I also am giving you the percentages for the federal unemployment tax and the state unemployment tax. So you don't have to memorize any percentages of any of the taxes, okay? The hardest part is going to be remembering the titles that go with the problems. So that's the biggest part, all right? So read the directions carefully. Maybe allow a couple extra minutes for this problem as well. All right, so let me show you a good one to study here. This is exercise 11.8. Now, I'm not worried about, it goes with 11.7, but this is exercise 11.8, and I just want to worry more about the percentages. Okay, so remember that your Social Security tax is 6.2% and Medicare is 1.45%. So this, for the exercise 11.8 going off 11.7, this is employee A. Okay, this is employee A. So your first title is going to be salaries expense. Remember, that is the total pay for that person or gross pay for the time period. Then you have your Social Security tax, your Medicare tax, then you have your federal tax. You may have medical expense or medical insurance on the test, so watch for that. That's probably all that we won't throw in there, union dues. And then your salary payable is what you're going to set aside. And then when it comes to payday, then it'll come out of that and they'll write you a check. Or direct deposit, which is greatest invention since sliced bread. Or unfortunately, if you do get a payroll card, which I hope you don't, then they'll put it on that as well. All right, so we take the 800, we multiply by 0.062 to get Social Security. You take the 800 times 0.0145 to get the Medicare. In this problem, they gave you the Fed tax, so you take your gross, subtract the taxes, and that's going to be your take home, okay? Just like in the real world. You don't get paid what you really make. We have taxes. We have state on top of ours, but they don't have state here, okay? So take your gross, figure out your FICA, Social Security, FICA, Medicare, and your federal tax. And then take your 800 in this case and subtract the 3, and that will give you your salaries payable. I'm sorry, my neighbor just drove his dirt bike through my yard, not very happy. And that gives you the salaries payable, okay? Now, for the employer part, remember your employer not only is paying you to work there, but they have to match your Social Security and your Medicare dollar for dollar, cent for cent. And then they also have to pay unemployment into the federal and the state on the first $7,000 that you make. So once you have hit that $7,000 for the year, they don't have to pay that anymore until January 1. So they have to match that or pay that until you make more than $7,000. Now, the taxes on this are a little more tricky, so you have to be very careful because I notice a lot with the percents. Federal is lower than state because we have to pay in a little bit for Fed, but more goes to the state. All right, so again, you're going to base this off of the gross, so the salaries expense. Social Security and Medicare, dollar for dollar, cent for cent, so they're both exactly the same. Then for the federal unemployment, take your 800. In this case, it was 0.6%, which is 0.006 in decimal form, and that gives you the $3.60. Then you take your 800. For the state, in this case, it was 5.4% or 0.0540, and that was 32.40. So again, gross times the percent given to you for the federal unemployment, and then the percent given to you for the state unemployment. For the titles here, you can put FUTA and SUTA, that's fine. And then once you get your 4 totals here, then you have to add those up to get your debit for your payroll tax expense, okay? So that one, if you forget, excuse me, then you just add up your 4 credits and that will give you your debit, in this case, $97.20. So for the employee part, again, it's salaries expense, Social Security, Medicare, and federal tax, and then your salaries payable. Then for your employer part, you have Social Security, Medicare, the match, your federal unemployment, your state unemployment, add those four together, and that's going to give you your debit for your payroll tax expense. Again, that's a big part of the test, so make sure that you know how to do that. You know the titles. Make sure you round. We don't want to short anybody any money at all, so use your rounding rules for the payroll. Okay, so that's two separate bullets on your review, but the salaries expense is the employee part, the employer payroll tax is the employer part. So make sure that you do study those and keep practicing payroll as well. Okay, times interest earned ratio. Okay, so for the times interest earned ratio, you did a quick study 1117, and let me see here if there's another one for that one. That might have been, oh yeah, and then you had exercise 1119. Okay, so I'm going to start with 1119, exercise 1119. Okay, so for exercise 1119, your formula is in your textbook. This is chapter 11, and this is on page 404 in the textbook. I'm not sure about the excuse me, on the ebook, but the formula is your income before interest and taxes divided by your interest expense. Okay, so again, income before interest and taxes, and then the bottom part are divided by your interest expense. Now, for this, they had 4 companies in exercise 11.9, and you had to figure out the times interest ratio for each company. So you have, again, your income before interest and expense, your income before interest and taxes, and then divided by your interest expense. So company A is 4.5, 11 for company B, company C was 15, and company D was 27. So that's your 4. Now, who's doing the best job? That's company D, because what we're looking at here is how many times we can pay the interest on our debt. And so they can pay it 27 times, which is great. You want that to be at least over 1 because you want to be able to pay your interest at least 1 time on your debt. So that's important to know. You also did quick study 1117. And again, same thing, income before interest and taxes divided by the interest expense. And then in this case, it gave you 13 times. Again, how many times they are able to pay the interest on their debt. So that's very good as well. Comparing to their competitors, this one was 4, way over. So that was awesome. Okay, other ratio is asset turnover. And with the asset turnover here, you had quick study 10-21 and exercise 10-24. So we had both of those. Quick study 10-21. With that, again, let me start here. This is from, again, chapter 10, and this is on page 373. This is the ability of the company to use its assets to generate earnings. So we're going to have total sales divided by the average total assets. Net sales divided by your average total assets. So net sales divided by the average total assets. So we had to take the 2 years, add them together, and divide it by 2, and you get 0.80. Now in this case, excuse me, their competitors were at 2, and they were only at 0.8, so they're a lot less. Again, you want to be able to use your assets to generate sales. So you want that to be higher than that, comparing that to your competitors. You don't necessarily have to be over 1, but the higher that you are, the better off that you are with that. All right, then for exercise 10-24, same thing. Net sales divided by your average total assets. They give you the first year and the second year. I'm sorry, yeah, first year and second year, add those together and divide it by 2. And then for year 3, same thing, net sales. This is year 2 and year 3, add those together and divide it by 2 to get your average total assets. Year 2 is 3.36. Year 3 was 4.59. They went up. That's good. And their competitors were 3, so they did way better. They improved their performance and are superior to their competitors. So again, you want to have net sales divided by your average total assets. If I give you the average total assets, don't try to do anything more with that. Just take what is given and complete the problem. All right, the last one is warranty work. That's the last problem that you will have. Now, with warranty work, this is like our allowance for doubtful accounts. What we're doing is we're trying to figure out what we think is going to become warranty work. So the first thing you're going to do is compute out how much you think is going to end up being set aside for warranty work or warranty expense. So in exercise 11-12, there was $6,000 for the sale, and 4% they think will become warranty work, or $240. So this is part A here, part 1. So then you take the cost times the percent, 4%, and then that's going to give you what they're going to set aside for warranty work, $240. So the title for that, when you go to journalize it, because you'll calculate out and then you'll journalize it, it's warranty expense and estimated warranty liability. Warranty expense and estimated warranty liability, $240. Okay. Now, when we need to get something fixed, we're going to take that money out of what we estimated and then fix the item for the customer. And so we take the money out of our estimated warranty liability. In this case, it was $209. And then we went to the back room. Let's say it's a copier. Yeah, this is a copier in this case. And we had to have $209 worth of parts to fix the copier. And so they take that out of the parts inventory, and then that becomes our credit. Because when we bought the parts inventory, it goes as a debit. So estimated warranty liability, debit. Parts warranty or parts inventory is the credit. So 209. So what the part you want to be concerned about with this problem is estimating the warranty and then journalizing it, and then you are going to figure out the cost of the warranty work with these 2 titles here as well. All right, so there's a lot of forms again. Make sure you save time to upload. You get 2 hours for the test. June 30th, it's our very last test. And then I'll try and get everything graded on the 1st, and then we'll be totally done with the class. Please make sure you take your time as much as you can, space it out, but don't forget to save time for uploading. Like I said, the payroll was the biggest problem. That's 22 points. And then some of them are between 13 and 16. A couple of them are 4 points. And a couple of them are, like 6 points and things like that. So please make sure you study. This is the last test, and a lot of students say this is the hardest test. So make sure you study, and make sure that if you have questions as you are studying, that you let me know. Send me an email, and we'll go ahead and answer any questions that you have. It has been my pleasure to have all of you. We started with 31 students. We've only we got 21 registered, but only about 18 of you are participating. So I applaud all of you. This was a hard 7 weeks. We had the hiccup with the security incident. I think some students just lost momentum as we were off that week. And but I applaud all of you for making it through that. I hope you did learn something. I think the biggest things, if you're going to own your own business, you know what a financial statement looks like, so you will not be taken advantage of, having embezzlement or something like that. You know what to look at. Knowing how to run your checkbook so that one person makes deposits, one person writes checks, and the other person reconciles that bank statement. That's important. And I know you don't reconcile in your personal life, but in business, that's a formal document we have to have. And then the last thing is payroll. Again, for your personal life, that's important to know. I'm sure a lot of you did not know that your employer matches that Social Security and Medicare dollar for dollar, cent for cent, and then they also pay into the state and federal unemployment. Some of you are lucky enough to have your employer help you pay with your health insurance, and so that they don't have to do that. Some of you get a 401k match if you put money in. They don't have to do that. So, that's awesome. If you're lucky to have a pension, some companies don't do that anymore either. So, payroll is important. We never want to be shorted. I think I said in my demo, they always, always, always check your check stub. Whether you're a salaried employee like me, or if you get paid hourly, you've got to double check, especially if you are expecting a raise or anything like that. Double check your payroll because there are mistakes. And don't just say, oh, well, because things are expensive. You guys know that gas is expensive, groceries expensive, rent's gone up. I know I just got my electric bill and, gas has gone up on that as well. So please make sure you're double checking your payroll checks and make sure you're getting your fair amount as you're supposed to. So again, it's been my pleasure having all of you. I applaud all of you for sticking with the class, and I do hope you learned something. Again, email me if you have any questions before we finish up the class with this last test. Thank you.